Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and start building your wealth.
I want to go ahead and kick things off. Go ahead and start, and Eric and I will watch the chat for you. You'll have access to the chat as well. If you see questions come in, just let us know how you want to handle that. One at a time, or it breaks, or what have you.
Sounds good. Carl, do you want to say a few words before I jump into it, or want me to just go?
Yeah, I'll say a few words. Matt is a a retirement mortgage professional, RMP. That's what your official title. And I'm a mortgage loan officer. I'm based in Charlottesville, and Matt is down around Raleigh. And Movement has in my opinion, one of the strongest reverse lending teams in the country. If you Google a guy by the name of Harlan Accola, Accola, he is the head of the reverse mortgage department. You will find him pop up on tons of podcasts and interviews and everything. We are on a mission to try and help people understand what this program is really about. We've hit peak 65 in the sense that there are more people are now 65 years old in this country than we've ever had before. And a lot of them are in a position where this type of program could be very beneficial to them, both for improving their retirement, improving their growth of their other assets, enabling them to buy a second home or investment property, which I can speak to. But I think what we'll do is we'll let Matt take it away. He's got a presentation that we'll let be the meat and drink of this, because he's a guy who knows his stuff. He's a loan officer who thinks like a financial planner. So listen close. He's got a lot of interesting stuff to share.
Yeah, thanks, Carl. Appreciate it. So a little bit about my background. I was in real estate for 14 years, mostly working with builders, developers, ran a sales team. I lived the real estate life for many, many years, and got into lending back in 2015. And I've been doing reverse specifically for the last 5 years. Reverse is something that I absolutely love. It's something that, as the majority of you could probably attest, you didn't know a whole lot about until you took my class. And tonight you're going to learn a whole bunch about reverse mortgage, and really I think that is going to change your minds about how reverse mortgages can be used, and it will have an effect on how you plan your retirement. I can say that definitively. I know that because I'm using a reverse mortgage for my retirement. It's already a part of my planning, and it's not because I need it. It's because I want what it's going to do for me, and there are huge, huge differences in my own cash flow if we consider using a reverse mortgage, my wife and I. Carl would also raise his hand and say, yep, that's a part of my retirement plan as well.
Oh yeah, I can't wait. So 4.5 years to go.
Yeah, we've got some time, and but as soon as we get there, we're going to be there. So I think where I'd like to start, and by the way, I encourage questions, so please kick them over into the chat. I have it open and active. This is about learning. We have a lot of information to cover, but I'm going to try to keep this very simple and very applicable. I think you've kind of heard the adage that knowledge is power, but applied knowledge is powerful. So what you're going to learn today, if you apply it, is going to be powerful for you, your family, and your clients. All right? So I think where I'd like to start is with a question. As you think about retirement, what is most important about retirement to you? And throw in a couple of answers into the chat, as you think about where you want to be in retirement, what you want to be doing in retirement. What are important pieces to that you would be considering? Okay, we've got health. Obviously, health is a big part of retirement. If we're not healthy, nothing else really matters, right? What else? What are some things that you'd want to do in retirement? Money for our car collection to expand.
Oh, I like that person.
Yeah, I like that.
Travel.
Yeah.
Okay, travel. time spent with kids and affording groceries, I hope we have enough money to afford groceries. So, I think what is retirement is very undefined for business owners. Very true, right? So there are two ways to approach retirement. And I'd like to ask this question, how many in the room, so to speak, want to just survive retirement? In other words, you got enough money to buy groceries, right? No one ever dreams about just surviving retirement, right? We dream about thriving in retirement. But thriving in retirement means that we need to have one very important aspect of it figured out, and that's our cash flow. How much money do we have coming in versus money going out? And I will make the comment that very, very few of us have planned well enough, if at all, for a good, solid retirement. It's just the status of America right now, and we deal with it every single day. So although a majority of us want to survive or want to thrive in retirement, most of us have planned poorly enough to just survive it, I think is the best way to say it. So we enter into a 3-bucket analysis of our money. All right, bucket number 1 is our income, is what we make. Bucket number 2 is our retirement bucket. This is money, hopefully, that we're putting in. This is 401k, IRA, investments. Maybe it's investment properties. This is what we're going to live off of when we retire. Bucket number 3 is our home equity bucket. And a majority of us put a whole lot more money into bucket number 3 than we put anywhere else. And you look at the wealth of equity for seniors over 62 in the Americas right now, we are over 14 trillion in senior home equity. It's massive, massive, massive number. But most people don't know how to access it. Because really there's only a few ways to access money during retirement, right? Through your home. You can sell your property, but that means you got to find somewhere to live. And moving in with your kids is not always the best answer. Number 2, you can get a cash out or home equity line of credit, but you got to qualify for those, and you got to make a monthly mortgage payment. Option number 3 is you use a reverse mortgage as a tool and a strategy in order to pull equity out of your home and use it to help you with cash flow and more safety and security in your retirement years. All right. So let's go through the basics, if we can, real quick, of reverse. And then we're going to go through the 3 most common clients for reverse, and then I'll open it up for questions. Okay, fair enough?
Yep.
All right. So to do a reverse mortgage, first off, you have to be at least 62 years old. All right. If you are married and you're 62 and your spouse happens to be 50, yes, you can both still do a reverse mortgage, but we're going to go off of the age of the youngest borrower or non-borrowing spouse as we work all of the numbers. But yes, at least one of you needs to be 62. And to describe a reverse mortgage, plain and simple, it is a mortgage. You don't have to make principal or interest payments on this particular mortgage. That's optional, and there's a lot of strategy behind that, but you retain the property as far as title. You can sell the property anytime you want to. You can pay down or pay off the loan balance. What you're agreeing to in this is that you continue to pay property taxes and insurance, maintain the property, pay HOA dues if applicable, and it needs to typically be the primary residence of at least one of the borrowers. So as long as all of those boxes are checked, then a reverse mortgage is a good plan for you. All right. Now, what happens at the end? At the end of a reverse mortgage, both borrowers in this case have passed away. The heirs of the estate, or the kids, right? They've got a decision that they have to make. Do they want to keep the house or do they want to sell it? If they want to keep it, they'll figure out a way to refinance the loan balance and they can retain the property. If they don't want the property anymore, they list it for sale, they pay off the balance. All of the remaining equity in the home goes to them. Okay, this is not an equity sharing program. Okay, the bank does not have an equity stake in the property. The only thing that gets paid back is the loan balance. All right? Timing on that, when mom and dad pass, the kids have 30 days to let the loan servicer know what their initial intent is, whether it's to keep the house or sell it. Then they have 6 months to execute that plan, plus 2 3-month extensions if they need it. Okay, so upwards of a year to actually execute either selling the property or refinancing it. The really nice thing about that is that the kids do not have to start stroking mortgage payments when mom and dad pass. Now I can tell you, my mom passed away way too early. She was 55. And I was the oldest of 5 siblings in my early 20s, and I was the only one that had the financial capacity to stroke her mortgage payment on her farm in Kansas. And I could only do it for 1 month. So we ended up having to fire sale the property because we didn't want it to go into foreclosure, and it was an absolute mess. If she had been old enough to have a reverse mortgage, it would have been wonderful. She could have continued to be in that home for the rest of her life, but when she passed, we wouldn't have had to, start stroking the mortgage payment, which is really big. Okay, so that's kind of the 101 on reverse. A reverse mortgage works for single family homes, townhomes, condos, as long as they're FHA approved. You can be in a duplex, triplex, fourplex, all of that works as well. Okay. What are some of the biggest concerns about reverse mortgages for people, right? If I was to ask this group, how many of you, aside from myself and Carl, how many of you have a reverse mortgage as a part of your retirement plan today? I bet you I'm not going to have too many hands raise up, okay? However, I'll ask the same question when we're done, and I think that we're going to have a few yeses in the room, if not a majority of you. Okay, that's how confident I am of the math. And that's the greatest thing about this program. Okay, I present for financial planners and CPAs all the time. And one of the questions that I will ask them is, hey, are you going to do this yourselves? And again, at the beginning of the class, I have very few yeses. By the end, I get a bunch of yeses. And I had a gal that came up to me in a class that I taught not too long ago. And she said, Matt, I really enjoyed your presentation. I just don't believe in reverse mortgage. And I said, well, here's the great thing. It's not a faith-based program. You don't have to believe in it. I said, do you believe in math? And of course she said, well, of course I believe in math. I said, well, this is a math-based program. And once you understand the math, it either works or it doesn't. I said, if you would like, we'll step into it further. And we had a great conversation. She's like, oh, I get it, right? So that's kind of the basics behind the principle of reverse. It's math-based, it's FHA insured, it's protected. This is not the reverse mortgages of the 60s, 70s, and 80s. All right, there were some bad programs out there that coined themselves as reverse mortgages, but really were not the FHA insured program that we have today. Okay? All right, so I'm going to dive into 3 different scenarios. The 3 most common types of reverse that we're going to see. And what I'm going to do here, we're going to say this is Henry Homeowner. Henry Homeowner is 62. And let's start with, I don't know, 600,000. Carl, is that a good value?
Works for me.
Okay. So a Henry Homeowner here has a $600,000 home, paid off, okay, owns it free and clear in Virginia. Now the first thing I'm going to tell Henry is there is nothing wrong inherently with having a paid off house, okay? It's fine. You worked hard, you paid off this house. However, Henry Homeowner has $600,000 locked away in an illiquid asset that has 0% growth. Now the reason I say that is it's the money that he has locked into it that's not growing. The actual value of the home is determined on what is happening in the real estate market. And so one of the things that Henry Homeowner could do is he could start a reverse mortgage. Now if Henry wants to do a reverse mortgage on his home, there's going to be some costs to do that, all right? The cost for a reverse is going to be a little higher than you would have for a traditional mortgage. One of the biggest reasons for that is the initial upfront mortgage insurance. This is based upon 2% of whatever the value of the home happens to be. So let's call that 2% of 600 grand is 12,000. We have loan origination, we've got title fees and costs, so 24,210 are the closing costs associated with starting this loan. Now remember, Henry homeowner here has a paid off house. So Matt, why would I want to start a loan balance of $24,000 if I have this paid off? Well, let's talk about what a reverse mortgage is now going to provide Mr. Henry here. So first off, there's going to be a line of credit that is going to be available. Okay? So the numbers behind reverse, this principal limit amount, this 2034, we like to call this the initial loan balance. This is the maximum amount of money that's generated for the reverse mortgage, which happens to be about 34% of the total value of the home. Okay? Now this is based upon the value, the age of the borrower, and where interest rates sit. So let's just kind of play this forward. So you take 2034, you subtract out the 24,000 in closing costs, that starts the loan balance. Henry homeowner is left with about $179,000. Okay, there's a portion of that that's available to draw in the first year, and then after the first year, it's all available. But let's look and see what Henry homeowner wants to do with this. So you're going to notice we've got a couple of different things in these boxes. We've got the projected home value at 600. We have the available line of credit, 179, 190. We have reserved equity of just a hair under 400. And then you've got your loan balance. The very first thing that I want you to look at is the green, the available line of credit. The line of credit within a reverse mortgage is very unique. It has a growth rate. And it is growing at the same interest rate that your loan balance is. So right now, we're sitting right around 6% as far as the interest rates on reverse mortgages. So if Henry homeowner starts a reverse at 62, doesn't need the money, all right, that line of credit is going to start to build for him every single year. And it will continue to grow and grow and grow. This is money that he can draw at any point for whatever reason, and it is always going to be available for him. This line of credit growth is happening independent on what the value of the home does. Okay, the value of the home could be absolutely stagnant. In fact, I could take our appreciation rate down from 4%, which is kind of the average there in Virginia for if we take it back historically. Let's say we have 0% growth. You'll notice the home value stayed at 600. The line of credit is now greater than the value of the house. Could Henry take out 615 in this moment of time? Absolutely. That's one of the reasons why that mortgage insurance is there, is it protects the line of credit and line of credit growth. That would continue to build and grow through time. Now let's just go kick this back up to where we think we're going to be as far as appreciation. Now at age 80, okay, again, Henry homeowner didn't need this money initially, but wouldn't it be nice to know that at age 80, Henry homeowner has access to $615,000 of tax-free cash flow if he decided he wanted to draw it for whatever reason? I don't know anyone out there that wouldn't like to have an additional $615,000 just in case.
Henry is going to have such an 80th birthday party.
Hopefully he invites us all on a big cruise, right?
Oh, yeah.
All right. Now, let's say that Henry wanted to sell his home at age 80. Okay? He's never taken out a dime from his line of credit. His home value appreciated from $600,000 to $1.2 million. If he wanted to sell, he'd list it for sale. He'd pay off the $83,000 loan balance. All of the remaining money, which is the reserved equity, that 516, plus the line of credit of 615, is all his. That's $1.13 million that he'd be able to take away from the sale. If you waited longer, obviously you get the idea, right? That line of credit continues to grow. Now, the line of credit can be drawn out for whatever purpose, okay? So we talked kind of a little bit about the investment side of real estate. What if Henry Homeowner starts at 62, and let's say at 65, he finds a property that he thinks is really going to work out for him. And he needs to take out $200,000 in order to put down on this property, renovate it, whatever he wants to do with it. So we're going to take a draw of $200,000. Start year 4, end year 4. Okay, so we just took out 200 grand. The great thing about this money coming from the line of credit is because it becomes lended money, it is not seen as cash flow. It's not seen as taxable income. It is cash flow, but it's not taxable income. If we move this needle forward a little bit, let's just say that he takes a year to get it renovated. He then goes ahead and sells the property, sells it at a profit. And he's got $250,000 now that is now in his checking account. He could very easily make a one-time payment in year 5 for $250,000. Okay? Immediately paying down the loan balance, and dollar for dollar, all of that money went right back into his line of credit, where it's liquid and growing for him. So this could be money that can be taken out, used, put back and forth, however this particular homeowner wants to use it. The great thing about a reverse mortgage is while he has money taken out, payments on this are completely optional. He can make a payment if he chooses, but he doesn't have to. We're going to get into the magic of making payments here in just a minute because there's something that's going to make all of you smile. But I'll hold off on that for just a moment. Another thing to consider here is what would happen if you decided to convert your line of credit into a monthly payout for you for the rest of your life. Okay? So as you can see your line of credit growing through time here, at some point, if you wanted to say at 76, your line of credit is now $506,000. If you wanted to take that line of credit and say, would you please pay me now for the rest of my life? Well, the monthly payout amount could be roughly $3,500 of tax-free cash flow that could be coming to this particular client for the rest of their lives. Pretty awesome. Okay?
It does stop once you turn 150. I'm sorry about that.
Yeah, it's only going to pay it out for so long. But very true. This note is going to be good until you're 150 years old. All right? Which is really awesome. Okay, so any questions about this? It's a great way to start a line of credit. You have line of credit growth. This is money that is accessible to you. You could, in essence, pay this loan balance down to about $100. We have a lot of clients that will do that. So let's get rid of this, and let's say that we do custom payment. I'm not going to be able to have that much go in there, but you get the idea. Do you see how we've paid that down? It's now $100. That loan balance is going to stay very, very small, right, for the rest of time. I could probably edit this and say that we're going to end this in the first year. We're only going to pay it once. That way you can see that loan balance increasing a little bit because there is interest there. But again, isn't this a wonderful nest egg of additional money that you could have just in case? The alternative is you have a paid off house, but you can't access the funds that are there.
Mm-hmm.
You can draw that money for whatever reason, whenever you want. The only cap on those draws is in the first year as far as the certain amount that you could take. Okay? Before I move on.
Matt,
Yeah.
So on the way the formula works, if you're looking at the box above the graph that shows the age, the equity reserve, reserve equity, available LLC. So the formula that the lender uses, it's it's gonna prevent somebody from borrowing too much. Like you give a stage, because everybody's always wondering what happens with mom or dad become incapacitated or pass away, and you haven't paid it off. And I guess the answer is, well, the heirs would sell the house, then the balance is paid off out of that, and the remaining proceeds go to the heirs. Is that well on track there? Is there any risk? Um, uh, you how do I want to say this? Is there any potential risk um, for a borrower using a reverse mortgage?
Yeah, so that's a great question.
Mhm.
If you're looking at risk, risk involves if you have to make a payment and you don't make a payment, you're going to lose the house. If you don't pay your property taxes or your homeowners insurance and your house burns down, those are going to be risks, right? With a reverse mortgage in place, as long as you continue to pay your property taxes and insurance, this home stays with you. The
Okay.
equity position, if you look here, is actually projected to grow through time if you've used all of your line of credit until we get to about 80 to 81. That's where you're going to start to lose a little bit of equity position, which means that loan balance is growing at about the same as the home value. But even if we took this to 90, at 90, if we just have a 4% appreciation rate over time, so this is 28 years from now at a $600,000 value. If this client decided to sell the home, value is 1.8, they pay off the $1.38 million loan balance, there's still about $412,000 remaining. We take this all the way to say 98, we're starting to get to where that loan balance happens to be the same as the value. Now, the loan balance could go higher than the value, but in that case, the heirs of the estate they still have the same two options. Do you want to keep this house or not? If they don't want it, because again, it's underwater, we hit another 2008 scenario. They wash their hands of it and say, hey, bank, here you go. Here's the keys. We're walking away, and they have zero liability. They do not have to bring in a single penny.
Mm.
Or this is a guaranteed short sale at 95% of the current appraised value. So let's say that we get into a scenario like this. Okay, appreciation is at 1%. It's really bad, but the loan balance itself, you can see it caps here because again, it's the value of the house that takes care of the loan. But if we hit to say 92, let's say that the value of the loan was at, I don't know, 1.6 million. The house value is only 800. The kids could walk away and say, hey, bank, here you go, we're out. We don't have to make, amends for any of the shortfall. Or they get an appraisal for 808. This is a guaranteed short sale at 95% of that current appraised value. So they could get a discount in a down market, retain the property, wait for the market to turn, and then make a profit on it. Okay, so there's, again, a lot of strategy in here for this, but I think the main point that I want to make for this particular scenario is if you have a paid off house and you are over 62, you should absolutely be considering getting a reverse mortgage in place because of the compound growth that's going to happen in that line of credit through time, which is going to build and build and build and build. Because again, who at age 90 would not like to have access to 1.2 million of their $1.8 million home if they needed it?
Mhm.
Right?
One thing, Matt, I'm going to jump in here with want to clarify that the reason that there is this guaranteed short sale, et cetera, is because, like Matt said, this is a type of FHA loan, and there is mortgage insurance baked into it. But the mortgage insurance in this case is designed to pay the difference between the balance and the value to create that guaranteed short sale in that scenario.
Correct. Okay, I'm going to complicate it slightly. Okay,
Okay.
We're going to say that Henry homeowner here does not own this home free and clear. He actually has $160,000 loan balance. Okay? Which, by the way, he tells all of his friends, he's like, hey, guess what? I did this loan, and Carl got me the most amazing interest rate ever. It was like 2.5%. I'm bragging to everybody on my low payment, right?
What a guy.
Now, again, just like with the homeowner that owned their home free and clear, there's nothing inherently wrong with that. There's also nothing inherently wrong with someone that's 62 that has a 2.5% interest rate and only owes $160,000. However, I would make the assertion that that payment going into a mortgage is not the most efficient thing to do. Okay, after we turn 62, and if we do not have to make a payment anymore on our mortgage, we really shouldn't. Okay, paying down your mortgage is not going to give you any more stars on your forehead on your deathbed. All right, you can put that money in so many other places, and we're going to start to talk about that. But let's talk about the math. So 2034, it's that same amount. We still have the closing costs, but we're going to pay off that loan balance. There's still some money left over, roughly $19,000, and this becomes the line of credit. So let's talk about what we got going on here. Let's say that this $160,000 current loan balance that we're paying off has a payment of $1,200 a month. And just for kicks, I know there's not 30 years left on this, but I'll show you why I'm doing this in just a minute. Okay, so the very first thing that this particular client gains is $1,200 a month in a payment they no longer need to make. Okay, so $1,200 a month times 12 is $14,400 per month. I love asking this question to our clients and those that are interested in doing this. Are you okay to make your payment? Yep. Do you think you could find a better place to put $14,400 instead of into your mortgage if you had a choice? 99% of the time, the answer is yes. I could find a better place to put $14,400. Okay? So we can do a few things with cash, right? We can spend it, we can save it, we can invest it, or we can give it away to charity. Spending this money, really fun, okay? Nothing wrong with that. Saving it, obviously I could put it in checking or savings, or I could just throw it into a money market account. But I could also do one-time payments on my reverse mortgage. So if I decided to make a payment on my reverse mortgage, which by the way, you might be asking, okay, Matt, I thought the whole idea with the reverse is I don't have to make a payment. You're very, very right. However, if you decide that you want to make a payment, this is optional as far as amount and frequency, because every statement you ever get in the mail is going to say that your payment obligation is zero. So if you decide to make a payment, this payment's going to do three things. First, it's going to lower down the loan balance. Second, dollar for dollar, it's going to go into your line of credit where it's growing at about 6%. And third, you're paying some interest. Okay, so you're going to get a wonderful 1098 tax form at the end of the year that's going to show you how much interest you paid. More on that in just a minute. But you can absolutely pay payments here if you choose. Now, another thing that you can do is you can decide to give this money to your financial planner. Okay, so what happens if you decide, again, you do a reverse mortgage, you're giving it to your financial planner, and your rate of return is 8%. You can see that I didn't have to make my payment. I'm now giving my payment to my financial planner. We're letting that money grow. It's growing at 8%. And if we take this out 10 years, you have $219,000 in that account. Take it out another 10, 706. To 92, $1.7 million of money that was going to a financial planner to invest so that you could have more money in bucket number 2. So again, I like to tell people this is all about efficiency of money, right? Yes, you can make a payment on your mortgage. Nothing wrong with that. But do you think you could find a better place to put that money to where it could be doing something for you in your retirement years that could be liquid for you that you'd be able to take out? That's what this is all about. Okay, I'm about to teach you something that is going to blow your mind. Okay, this is where my multi-millionaire clients all of a sudden get very, very excited. They don't need this program in order to enjoy a good retirement, but they like what I'm about to teach you. Now, big asterisks here, guys. I am not a CPA. I am not giving you tax advice today. But what would happen if instead of making payments on your reverse, you got a reverse mortgage and you let this loan balance grow? And I'm going to say that we're going to let this balance grow by $100,000. We're going to take this from 184 to 284. 1, 2, 3, 4. So let's take it about 7 years. Okay? So on the surface, you might say, okay, Matt, that's great. I didn't have to make a payment, but my loan balance went up by over $100,000 in 7 years. That's bad, right? So, well, not necessarily. Because with the right strategy, this just opened up a huge door and window of opportunity for you. Let's say that you have a 401k, an IRA that are taxable, okay? Money went in there pre-tax and you're going to have to take that money out at some point, and that's when you have to pay taxes. Or let's just say you had a really good year in real estate and you couldn't figure out a way to write off $100,000. Okay? So you've got a 1099 that says you made $100,000 this year. You're going to have to pay Uncle Sam on that. However, instead of paying your 24-28% tax bracket, you say, well, hold on a minute. Because at year 7, I decided to make a payment for $100,000. And when I made that payment, 3 beautiful things just happened. First, my loan balance dropped by $100K. Second, my line of credit just increased by $100K, and I can take that money out if and when I ever need it. Third, I just paid about $80,000 of mortgage interest. I would be getting a 1098 tax form in that tax year that says so. This is something that I could rinse and repeat every 7 years. In this scenario. So we do it again. In 14 years, we paid, and again, I took out $100,000 of taxable money. We made a payment. We get a 1098 that says that we paid $91,000 of mortgage interest. Beautiful. This is what this looks like as far as your strategy on your schedule here. All of that money is going right into your line of credit. It's keeping your loan balance small. That is money that is liquid and accessible to you at any point for whatever reason. Okay? Really, really fun when you start to look at these numbers. Again, it's all about math. All right, so we've covered the homeowner that owns their home free and clear. We've talked about the homeowner that has a mortgage. What about the homeowner that's in a wrong house and they would like to get into something different? Now, I'm going to preface this by giving you a real life scenario when I was a real estate professional. Okay. So as a real estate professional, I had a borrower that said, you know, Matt, we have to sell our house. I said, why? What happened? He said, well, my wife fell down the stairs, and you know, we have to get into a home that's a single level rambler. I said, great. So I went over to their house and I said, all right, guys, where do you want to go? They said, well, there's a community up the street that we really want to move into. And I said, okay, I know which one it is. Love that community. There is some availability, but I have some bad news. The starting price of that community is $700,000. And, you know, they kind of looked at me and they said, well, how much can you get for our house? And I said, well, I can net you about $500,000. And they said, oh, shoot. I said, well, hang on. We only have a $200,000 shortfall here. Let's figure out a way that we can make this happen. I said, could you get a loan for 200 grand? They said, we're on Social Security. We don't have enough income, and nor would we want to open up a scenario that has us have a monthly mortgage payment. I said, okay. Do you have any retirement funds? And they said, we do, but we only have $400,000 in there. And if we take out half of our retirement, that's going to be very painful. I said, all right, well, what about family that could help you? I'm grasping at straws, right? They said, yeah, that's not going to work either. I said, all right, well, I'm sorry, but I don't think I can get you into that $700,000 home. And I ended up getting them into a home across the valley, 475. It still worked. It was okay, but it wasn't where they wanted to be with their friends. Had I known about this program, let me show you how amazing this is. Okay, they're about 75. Purchase price, 700 grand. Okay, if they wanted to buy a $700,000 property, they had $500,000 from the sale of their home, and they wanted to use a reverse mortgage as their financing to do it. The reverse mortgage down payment amount, which includes the closing costs, would be $430,000. Now for them, at that moment in time, it was only $400,000. It's pretty dang close. But let's just use this math. Well, they've got $500,000. They only have to bring in $430,000. The reverse mortgage loan proceeds bring in the rest, and they would have been able to add to their retirement account an additional $70,000. The real numbers for them is they had an additional $100,000 that they'd be able to add to their retirement account. So had I known about this program, I could have got them into the home that they really wanted, in the community that they wanted with their friends, and I could have had them add an additional $100,000 to their retirement account. Do you think that would have helped put them into a better financial position? Absolutely. Absolutely. But I didn't know that this was available. Okay, so let me fast forward to my dad. My dad was my very first reverse mortgage I ever did. Okay, he comes up to me, this is 7 years ago, he says, Matt, I want to sell my house. This is at Thanksgiving, okay? We're all there. I said, Dad, why? It's an 1,800 square foot Rambler in St. George, Utah. It's beautiful. He said, it's not big enough. And I want a pool. I said, okay, Dad, what do you want to buy? He says, well, I've got a home I want to build. Purchase price is going to be $620,000. I said, Dad, your home is only worth $300,000. You know that, right? He says, yeah, so I'm trying to figure this out. I said, well, Dad, you got three options. You can sell your home for $300,000. You can take out $320,000 from your retirement account, and you can buy this home cash, and you won't have to make a payment. He said, yeah, I'm not very excited about that. I said, okay. Option number 2 is you get a loan. He says, what's my payment going to be? I'm like, yeah, $2,000 plus a month, give or take. He said, yeah, I'm not excited about that either. I said, all right, option number 3, I need to go learn about. And I did. Now remember, I had been in the industry at that point for 23 years. I had heard whispers of reverse, but I didn't get it. I didn't understand it. So I learned about it. My teacher told me, all right, $300,000 home, no problem. What does he want to buy? Like, he wants to buy something at $620,000. Okay? Your dad needs to bring in $380,000 to purchase a $620,000 home. I said, wait a minute, time out. So my dad just brings in $380,000. The loan brings in the rest? He says, yep. And he doesn't have to make a monthly mortgage payment for the rest of his life? Nope. Just has to pay taxes and insurance? Uh-huh. He can sell the property if he wants to. Equity's his? Yep. I said, seriously? He says, yeah, isn't this awesome? I took it to my dad. I'm like, Dad, you're not going to believe this. You only have to bring in $380,000. He said, what's the catch? I'm like, there is none. This is an FHA insured program backed by HUD. You bring in 380, which means you still have to draw out 80 grand from your retirement account, but you're able to buy your dream house and live in it for the rest of your life, and you never have to make a monthly mortgage payment. He said, Matt, why doesn't everyone do this? This is the biggest no-brainer in the world. I'm like, Dad, I've been in the industry for years now, and I just barely grasped it. So I want you to think about the number of people out there that are stuck, so to speak, in a home that they don't feel like they can get into what they really want or need. Maybe it's because whatever's out there is more expensive than what they really want to buy. Maybe that $300,000 home that they have right now, they're saying, gosh, it really doesn't work for me. The house I really need to get is 400 grand. I just don't know how to get there. Well, awesome. Because if you decide that you want to buy a $400,000 home, and that's the home that works, and you've got $300,000 from the sale of your home, you only have to bring in $249 to use a reverse mortgage in order to be the financing arm to buy this house. That means you're going to have $50,000 left over. You got into a more expensive house that better fits your needs, and you do not have to make a principal or interest payment. Okay? Pretty dang awesome.
Sweet.
These loans are so cool, guys. And I know that the hour that we have had has flown by. So I'm going to stop share. We'll go into any questions that we need to go through here. And
Hi, I just want to take a moment to thank you for watching a recording of the Monday Night Live class. Hope you're getting a lot out of it. I'm sure you will. I wanted to let you know that, you can come to Monday Night Live whenever you want, but you can also participate more with the team. Why don't you set up a call with me, a one-on-one strategy call? I can go over everything with you, show you everything that we have to offer. For example, did you know that on our team, not only do you get your leads, we actually give you your own account on our lead gen system. So this puts you in control. You're not waiting on somebody to hand you leads. You get to pick the ones you want. Okay? Huge difference. We have 21 of our own proprietary marketing campaigns. They're all copyright protected. We're the only ones that can use them. Okay? The coaching is absolutely one-on-one. We got 3 coaches. We even have a 4th success coach that we have access to. Okay? One of left fewer than 100 in the world. Okay? One-on-one coaching. Right now the big problem is volume. We need more transactions. We need more inventory. I get it. Well, we know how to get it. Our team actually outproduces the national average by more than 2 to 1. So if you're struggling, don't do that anymore. If you're a solo agent, if you're a team, let's just talk. Smart entrepreneurs are always open to discussion. Learn what we have to offer, and then you can make an informed decision about staying where you are or moving on. You've got to decide, if you're not where you want to be, you've got to take action to get where you want to be. Let's see how we can help you do that. I look forward to talking to you. Click on the link, set up a call. And by the way, I'll see you on the next Monday Night Live.
Yeah, Matt, I'm sorry. Let me jump in real quick. Folks, I don't know if on this call you're focusing on the investor side of things or the realtor side of things. I had clients who were in the exact situation that Matt was talking about. They had to get out of the house that they were in, and they could only qualify for like a $300,000 house using a traditional mortgage, and they needed something more along the lines of $550,000, and the reverse mortgage made that happen. And they are over the moon about it. They got the house that they need. It's close to where their daughter lives, and one thing that I never thought about before, but the biggest thing that meant most to the husband was that if he passes away first, his wife doesn't automatically have to sell the house because there isn't that monthly obligation. And even with the loss of his retirement, his Social Security income or portion of it, it won't mean that she automatically has to do that. So I just wanted to throw that in there. There are a few questions.
Yeah, so I'm kind of going through these. Let's go ahead and hit them. Catherine, someone decides to make monthly payments. You can still make payments back. Absolutely. You can make a payment back whenever you want to for however much you want to. Again, you have to think about this reverse mortgage as a tool. You can put money into it. You can take money out of it. But anytime that you put money into it, it's growing for you. It's like you've got checking, savings, and now you've got a reverse mortgage account with growth. It's absolutely wonderful. Whenever you want to make a payment, do we require flood insurance? Only if it's required and it's in a flood zone on FEMA's maps. Does it work for an irrevocable trust? Sometimes. So revocable trust, piece of cake, right? You can put properties and things in and out of a trust. We can still work with irrevocable trusts. There can be some language changes that possibly need to be made, but we love working with trusts. I would advise everyone get a trust, as far as being able to manage those assets and pass a cleaner inheritance to your kids. It's definitely the way to go.
Matt, Kathy had one other part to her question. She was asking, if you start taking monthly payments, regular monthly payments like you were talking about, can you stop that?
Yeah, because every statement you ever get in the mail says your payment obligation is 0. You can make a payment 1 month, you can wait 3 years and then make another payment.
Yeah.
You can make payments along the way. Again, this is just putting more money into your line of credit, keeping your loan balance small.
Yeah. And you can change what you get, what you take out of it as well.
Absolutely.
Yeah.
Absolutely. Okay. Let me I'm going to share this with you because I think this is really fun. This is a little spreadsheet that I did earlier today. And basically what this shows is, okay, here's your investment account. This is money that you've got invested, growing at 7%. This was an actual client that had me work this up, okay? He wanted to take out $200,000 a year from his retirement account. Okay, so his initial plan was, I want to start taking draws at age 66. Okay? Well, if he started taking $200,000 a year at age 66, by the time he reached 89, that money was gone. Okay, he would have blown through this. But what we decided to do is say, all right, well, what if you set up a reverse mortgage? His initial line of credit's 387. And during these first years that you were going to draw from your retirement, you decided not to. You let that money grow by 7% on average here. He's been averaging 8, but I'm like, let's just go a little more conservative. But if he was to take out $160,000 from his line of credit in those first 3 years, and then switch over to drawing out the $200,000, look at his retirement account. It is very, very, very healthy. And that was just a 3-year period of time. So when we look at this, we're always looking at coordinated strategies. How can we provide the very, very best outcome for someone's retirement? And this is going to be, based upon research that's been done by Dr. Wade Pfau and Barry Sachs and others that have corroborated to say, okay, what does retirement look like with the reverse mortgage in place? And what does it look like without? They've done the simulations. Every time it looks better with a reverse mortgage in place, oddly enough. And that includes the loan balance growing through time. Again, it's all about efficiency of money. Where do you put money? When do you take it out? Of which accounts? How much? And that interaction between the two, that's where Carl and I geek out. Okay, we have a lot of fun working those numbers so that you can see it. Okay, we got 1 minute left. I have a big ask for all of you, and I'm going to put this into the chat, okay? Please, please, please reach out to either myself or Carl to schedule a one-on-one appointment. I want to be able to show you your scenario, either for you or your parents. Maybe it's a client, but I want to show you the math. Okay, I'm 50. I've got a ways to go before I can do my own reverse at 62, but I've already gone through the math of what that looks like. I already know, and my financial planner already knows and has it inputted into what my retirement looks like. And I promise you, once you see how this works for you, it is going to be life-changing for you. Okay? The whole reason for today's class was to change your paradigm on how you thought reverse mortgages worked versus how they actually work. Okay? So there's my email. Carl's going to get his in there.
We got him in there. And Gary's got a question.
Yeah, two questions, really easy. So the first one is, are the interest rates on a reverse mortgage calculated similarly to, rates on conventional mortgages like regular mortgages? In other words, you make an index and is there any difference out of the ton calculated?
Yeah, great question. So the interest rate environment on reverses, we base them off of the constant maturity treasury index plus the margin. Typically, we're about a quarter point or under where traditional mortgage rates sit. So today we're sitting at 5.875. And again, we don't work with points and discount points and all of that. It's just where we're sitting today.
Okay. And then the other question, I think I already know the answer. I mean, if someone was 62, theoretically, they still got a lot of gas in the tank. Does it really matter what they do with the money? If they pull money out in reverse mortgage, they can use that to do other investing, right? Like buy a duplex, things like that, flip a home.
Absolutely. People do it all the time. They
Yeah.
can use it to buy, fund a legacy property, down payment on something at the beach or in the mountains. They can use it to fix and flip. It's their money. This becomes a tool now that they can use as far as accessing funds within their own house to be able to do it. And the difference between a normal cash out refinance or a HELOC is you don't have to make monthly payments on it back. And that total account is growing for you through time.
Okay.
Yeah, I also had some clients who they had refinanced their primary residence with a reverse mortgage, which improved their cash flow enough that it just made it easier for them to qualify for the purchase of an investment property. So that's another way that it can be used. Matt, I don't know how much, or Gary, I don't know how much time we still have. I see another question from Tatiana about the ratio of the loan versus the home value. Do you see that, Matt?
Yeah, so that's going to depend on age. So if you are closer to 62, you probably have access to around 30% of the equity of your home. If you're closer to 90, you're going to be kind of closer to 65% of the equity position of your home. So again, depending on where you are age-wise, which makes sense, we'll lend you more money if your life expectancy is shorter, because we know that it's not going to get into an upside down position. It's still FHA insured either way, but if you're going to be doing it when you're younger, you have a smaller amount to start. Now that smaller amount compounded through time is going to give you more money than if you wait to do a reverse. And mathematically, it's very easy to show that. It's a compound growth of that line of credit through time. Another question that was out there was, does it need to be a primary? Must you live in the property? FHA's guides say this, that the home is typically the primary residence of at least one of the borrowers. So as long as that's true, then you're good to go. We have a lot of people that will do service type missions or religious missions that will go and leave their house for a year or 3 years. That's allowed. As long as you don't rent the property, you continue to pay property taxes and insurance, maintain the property, keep it as a primary, right? You're not buying another property where you're going. As long as all of those are accurate and true, you're golden. Okay, now I will add this. How in the world do you talk to clients about this? Because seriously, if you have someone that comes in and you know, let's say that someone says, hey, I want to buy this house, and you say, great, how do you want to buy it? I want to buy it cash. You're like, okay, awesome. But in the back of your mind, you're like, wait a minute, Matt did this whole thing on reverse mortgage, but how do I bring that up? What I would say, if Carl is my client, I'd say, Carl, I appreciate the fact that you can buy this home cash. However, I am aware of a pathway that could allow for you to keep more of your money liquid in your retirement years and still achieve the same goal of not having to make a principal or interest payment. Would you be interested to learn more? Yeah. Because you can tell me that I can achieve the same goal of not having to make a payment, but I'm able to keep more of my money liquid. Oh my gosh. You just became more than a real estate professional to me. You became someone that is helping me manage my real estate assets and help me for my retirement. And that is huge. And I get the feeling from this group, you guys are about investing, holistic approaches. So I'm excited to do some one-on-ones with you so that you can understand how this program really is developed and what it is that you're doing and how it can play out not only for your clients, but for your own retirement.
Tatiana had another question about whether it's a fixed or adjustable.
We have both. You have fixed rate and adjustable rate. The adjustable rate is far more popular because it's an open-ended loan. That's what gives you the ability to make payments in and take money out, right? If it's a fixed rate reverse, it's a one-time closed-ended loan. Here's your money. You're done. You don't have to make any payments. If you do, it'll lower down the loan balance, but because it's a closed-ended loan, you don't have access to the money. I've only ever done one fixed rate reverse because of that fact. You know, you just have so much more flexibility. It's kind of like a Swiss Army knife instead of using a single switchblade. Right? There's just so many things you can do with it.
So does it work like equity line? Like every year it adjusts to different number?
Yeah, so every month it could adjust.
Every month.
But it's going to follow very closely to where interest rates are for traditional mortgage loans.
So what is the relation between the interest on your principal, and you mentioned that it may grow at around 6%, right? So is it happening at the same time?
Yes, they both grow at exactly the same rate.
Oh, exactly the same rate. Oh, interesting.
So you're not very sad if interest rates go up to 8 or 9%, because you can throw a whole lot more money into that line of credit and have that line of credit grow, and you can take that money right back out. Again, there's so many different ways to use a reverse mortgage. I think one of the things that we pride ourselves on here at Movement is we focus in on the strategy and helping you implement it through time. We continue to be with you year after year as that strategy needs to morph and change.
And if we have client who might be interested, so would you talk to that client?
Yes, absolutely. We'll get them in a Zoom environment or in person, and we will have a strategy session, go through what their needs are, and we're not pushy. This is all about, okay, let's look at the pathway you're currently on. Let's look at a pathway that would include a reverse mortgage on how that looks. And 9 times out of 10, people are like, okay, where do I sign up? This is so cool. Because it really is. It is an awesome premium loan. And unfortunately, we've just done a really bad job as an industry talking about it. And Carl and I are doing everything we can to rectify that.
Feels like an uphill battle sometimes, but we're doing our best. And you can now, I think all of you who are here can see why. Yeah, Matt, Val had a question. It's a little farther back up. As for title holders, it starts out. Do you see it?
Yes.
Okay.
If you're on the deed, paid off with a parent 80, and I'm about 7 years from being eligible, is that an option to use, or must you be married? So the way that I would structure that one, Val, if if your parent is 80, they can do a reverse mortgage immediately. That's going to open up the line of credit. It's going to open up all of the bells and whistles. If they pass, remember, they can have you as the successor of the property, right? Whether it's in the will or a trust, saying when we die, Val, this is your property. So let's say that they have a reverse mortgage on it. They're kind of using some of the line of credit. They pass away. Well, at that point, you now have the title to the property. You then decide, do I want to refinance this and keep the home, or do I want to sell it? If you're old enough at that point, you say you're 7 years away from 62. If you're 62 at that point, you then look at the numbers and say, okay, well, what was the payoff to pay off the reverse mortgage as it sits to the value of the home? If there's enough money there, you can just get a reverse mortgage and immediately just keep doing what your parents were doing on it. But yes, that's a great scenario for us to run so that you can see in the future under XYZ that your parents, use some of the line of credit or don't, what that would mean for you 7 years down the road. If they pass before 7 years, then really your only option would be to refinance the loan, which should probably be pretty small, to keep it or sell the property. Great question, though.
Yeah, definitely good stuff. I mean, you think about the interest rate environment right now, and it looks like we're going to have a couple of rate drops this year too. You know,
Yeah.
I could think of a lot of ways. Like you might have to pay, say, 5% on this. You accumulate. I mean, if you were balance accumulating, over time because you're not making payments. The reality is I could take that money and I could think of a dozen things I could put it in to more than make up the different, the rate that I'd be paying on the loan. I mean, just some easy solutions. Some of them low risk, compared to owning some rentals. So, yeah,
Yeah, absolutely.
people stay in the house and
Yeah. One other thing that I want to point out, whether you're on the realtor side of things and you're calling expired listings as a way to generate business, or on the investor side of things and you're dialing or postcarding, a certain, farming a certain neighborhood for properties that you want to purchase. What one agent I know referred to as objection number one is always, I mean, for a person who's 62, but where would I go? Where would I go from here, even if I did sell my house for as much as I can get, or as much as you're offering? And if they're 62 or over, that's, this is the answer. That word track that Matt gave us, that I will email out to everybody if you'd like, is the answer to that. And I think that any agent for whom calling expired listings is part of their strategy, if they make sure to understand this well enough to talk about it, that could give them a real unfair advantage in generating business.
Well, if you think about it, Carl, it's a great point. As a real estate agent, you're trying to get as much money as you possibly can for your client, right? And let's say that the market just doesn't support what they need. They needed to sell that $300,000 or $400,000 home or $600,000 home so that they could afford to get into the $700,000 home that they really wanted. But for some reason, the market just didn't support the house selling at that price point. The great thing about a reverse mortgage is they don't need that much money. They could actually sell it for less, right? So, I mean, if I show you this really fast here, we go back in, let's say that, again, they were trying to sell, let's just go off of what we just said here. And put in that their current property value is 500 grand, and they really want to buy something that is 600. Well, if they're 75 and you're trying to get this home sold at $500,000, it just won't sell, just won't sell, just won't sell. Well, what if you lowered the price down to 450? they can still buy that $600,000 home because they only need to bring in 372. You know, if they really drop this down to the bottom barrel of say 400,000, they can still buy that home and they still have money left over. So there's the side of it of saying, you know what, you don't need as much money from the sale of your home. It's always nice to have it. I'm not discounting that. I'm a homeowner too. I like to get top dollar for the sales price of my house. But if this is my dream house and this is the one that I want to get into, and I'm stuck at a $500,000 amount because Carl can only finance me for 100 grand, and that's all I can afford. Well, you change the math. You say, guess what? You only have to sell for 400. We only need 372, and you can buy that $600,000 home. You just put 27 grand in your pocket. So again, a lot of opportunity here.
Can we have access to this tool?
Yes. So, okay, this software is something that we pay for, right? As far as being able to do it. But Carl knows this as well as anyone. I love setting up meetings to just run through stuff. You can send me, hey Matt, here's my client. They're 62, they want to buy this, how much? And I'll do a little video, shoot it over to you, let you know what it looks like. We'll work on the strategy together and work with getting the client on board. The process is actually very, very fun. It's very simple.
Yeah.
And we have a guaranteed close on these, by the way, in 17 days. That's pretty awesome. You give me 17 to 30, I'm super happy. But we do move these through very, very quickly.
It just so happens I'm going to Vegas in 18 days.
Well, there you go.
No, just kidding.
We better get cracking. If I want to take a minute and brag about just a side point that software that Matt was using, someone else from Movement's reverse department is the creator of that software. Him and his partners.
Yeah, Dan Holtquist.
Yeah.
FHA will call Dan to ask them about their own program as it relates to reverse. That's how respected he is in the industry. And we have of the top 10 reverse originators in the country, Movement has 6 of them. So we are very, very serious about what we do. We love what we do. We've taken the time to get educated and, as certified reverse mortgage professionals, this is what we live and breathe every day. And, I think the coolest thing about this, and I've said this before, this truly changes people's lives. You're talking about someone that goes from, I can barely afford food, to I can now live. I can now enjoy a better retirement. I've been able to watch people double their cash flow position or better, and it makes all the difference in the world. Or getting that client that Carl was talking about into a home that they didn't think they could ever afford. To be able to get them in there, they don't have to make a mortgage payment.
Right.
Huge, absolutely huge.
Please forgive me if I leaked out a just a moment ago, but is that calculator on the the Movement mortgage website?
It's not.
Where you can plug in. Okay.
Yeah. It's not. Yeah, we don't have that interactive piece to it. But again, use me, abuse me. Giving you access to my calendar, just fill me up. With time slots that you need. Both Carl and I are here to live and serve and to help you to build your businesses and to create opportunities for you. Carl, he hasn't been touting himself. Fantastic loan originator if you've never used him. Does a great job, really cares for clients and goes the extra mile. And I
just want to thank you guys both for coming, because I really enjoyed the CE class that I took with you guys and thought it very, very informative. So I'm glad you could come and share with the rest of my team.
Thank you, Catherine.
Yeah.
Thanks, Kathy.
Well, Gary's.
And thank you, Kathy. Everybody, give Kathy a pat on the back too for making this class happen. So, yep. Good stuff. And I'm going to set up an appointment now because I do have a unique situation. It's not my home. It's a family member's home, but it's a little complex. So,
Love it.
couple of siblings involved, and we happen to be like Irish. So it's, if you can imagine,
Mhm.
it's just like in the movies,
I love it. I love it.
And we
He's
were kids.
ready.
We would fight. We would
It
fight for
is
fun.
March, right? It's getting
That's
close
right.
to St. Patty's Day,
That's
so
right.
we're all for it.
Yep. Okay. Well, thanks guys for coming to do this, and for everybody participating, agents on the team and guests. If you have questions, like I always say, right while the iron's hot. You know, tomorrow will be a brand new day, new challenges. So if you have questions, better get them in here real quick. It's 20 after 8. And if not, I thank you all for participating, and definitely, Paul and Matt, thank you for giving your personal time to do this. I know it's evening and now past dinner time, so we really do appreciate you doing that.
You're welcome. That's my cell number, by the way. So
Okay.
text me if you have any questions, if you want to set up a time. The Calendly link's in there. But yeah, truly,
Okay.
thank you so much for the opportunity to teach.
Yeah. Thanks, everybody.
We love it.
Okay. All right. Well, everybody, hope you have a wonderful evening. I'll see you, the GIA team members. I'll see you Wednesday night. Make sure you're on the Wednesday night, this month's monthly session. We have 2 critical announcements for you, both good, by the way. So, in fact, really good. So please make sure you're there. Tell your teammates to make sure they're there too, and we'll be glad. So, in any case, thanks again, Matt, Carl. I'll be reaching out to you, setting up a call, and anybody here that has a client or family member that could take advantage of this, I do the same. That's the bottom line is this: traditional home equity loan, you have to make payments on that. Reverse mortgage, you don't make payments. You know, there's some safety nets built in. They're better today than they were 25 years ago. I can tell you that.
Right.
Yeah. Okay. Good to see you guys.
Okay, thank
see
you
you
all.
all.
Have a great evening.
Thank you.
Thank
Have
you
a great
as
evening,
well.
everybody. Thanks for coming.
Okay, take care.
All right,
Yeah,
everyone.
thank you.
Thank you for watching Monday Night Live. Consider subscribing. Agents, want to learn more? Schedule a call with Gary using the link in the description.